In this video, we're going to talk about the last type of closing entry, which is going to involve owner drawing. We have brought sales to zero. We have brought all of our expenses to zero. As I had mentioned at the end of the last video, we actually brought income summary to zero, meaning that we have equality with debits and credits here for income summary. So we have the same amount of debits as credits, so they would cancel each other out. And the last one is owner drawing. In the last video, we talked about, oh, I didn't put the transaction date in there. Every one of these transactions needs to have a date. My bad on that. So in the last transaction, we infused the net income into owner capital. We increased it. And the corresponding debit then was the income summary. Let's say we had a net loss. That would be in the debit column because we would be lowering owner capital. The corresponding income summary would then be in the credit column. They would just be opposite each other. But we're going to do the last one here, which is owner drawing. If I could do the date right, that'd be wonderful. Okay, let's bring our worksheet back up. We're almost done here. Our capital amount is $12,100. Our drawing amount is $460, meaning that we took out $460 over the course of the month out of the business for personal use. This is physical cash we're moving from the business. So here's how we're going to. $460 is our operative number. So we're done with income summaries right now. We're going to put in the capital amount and the drawing amount, or the drawing account. As we mentioned, owner drawing is a temporary account that needs to be brought to zero. So as of the end of the month, owner drawing has this $460 debit balance sitting there. So in order to bring this $460 debit balance to zero, we're going to put into owner drawing a $460 credit. Easy enough. Now that would be brought to zero. The capital amount is going to get the corresponding debit here, and that makes sense because whereas the net income increased capital with a credit, anytime we take money out of the business, it decreases capital with a debit. So as you can see, we continuously have a journal that is equal in debits and credits. Every single one of these transactions has equal debit and credit parts. We've infused net income into owner capital in the third one here, and we have removed the drawing amount from the capital in the fourth transaction here. These are the four types of closing entries as prescribed by our textbook. An individual accounting company or a company that has you working as an accountant may do things slightly different, but the bottom line is income summaries in this case are often put in there as kind of dummy accounts to make debits and credits equal in the journal only. At the end of a fiscal period, income summary along with all sales, expenses, and drawing need to be brought to zero so that we can start fresh in the next fiscal period. Remember, all permanent accounts do not have any kind of involvement here in closing entries. None of these are permanent accounts here. These are all sales, income summary, expense. The only permanent account is just getting adjusted here, and that's the capital. So capital is permanent, but it just gets adjusted either one way or the other, depending upon whether we have a net income or net loss. So these are the four types of closing entries. The next video we'll talk about taking the information that we put into the journal here, all adjusting entries and all closing entries, and we have to put them into the ledger to bring our ledger up to speed. And after that, we're good to go.